Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
You can reach us at 855-226-8551 or info@yourmoneyontap.com. Operators are standing by. Ben Brayshaw and Seth Krussman are here today for you, standing by for all of your money questions. Nothing too big, nothing too small, right? We love just getting the questions. Everybody is entitled to have their experience in life.
I love some of the phone calls and conversations we have with people. It's really very interesting.
The best ones, I think, for me, or usually do start out like with that, I'm sorry for asking this question, or like if people feel like they should already have an answer in place for something they're about to ask.
But that's the standard.
Yeah.
I mean, that's the standard in every conversation I have with people walk through the door. They think they're walking in with some sort of, oh, I want to do all this. If you had all the answers, you wouldn't be walking through the door, and that's totally okay, and people don't. And
hey, that's me in Home Depot, trying out
that's me in everything
stuff.
Else. That's me and my children.
know, right?
So, I mean, we just don't know what we don't know, and that's okay. And I think the thing is I love the fact that, our disposition is to educate and empower you. And so we want you to ask questions, because the more empowered you are, the better investor you are, the better person we can work with. I mean, if we have to, if we have to start from the ground up, that's okay. But we want to get you to the place where you say, that makes sense. I want to do that. I think I can do this, or
right.
or this is going to fit my need. I want you to be confident in the decisions that you're moving forward with. And that's the best kind of investor we can have. Somebody who goes home and doesn't sleep well, or it's bothering them, that's not a good fit, and that's okay.
Yeah.
I mean, it really comes down to really just finding something you're comfortable with. And I think, with today's show, we're going to talk about IRAs. We're going to talk about, lots of different pieces to it. I mean, we were just joking around, tips and tricks or whatever you want to call it. But it's not. But it's a conversation about retirement. And it's the IRA retirement story. What is the one you're working around, and what are the questions you would have? And here's what you got to watch out for. And we have 10 of them today. And I think we're going to have a great show, because I think the conversation around it is so much bigger than 10. But, I mean, we were talking about it as we were going through it, like, we'll just come up with, we just came up with like, let's just come up with 10. And
it started as 20.
It started as 20. That's true. It started as 20. It's down to 10, and all the other 50 will be buried in some sort of the conversation. So if you don't have all the answers afterwards, that's okay.
Before we get into the meat and potatoes of this show, we're going to take a minute to talk about some money in the news.
Well, we got kind of a big deal conversation going on with money in the news today, Seth. The big news is Bernie Madoff died at 82. He was the mastermind of the giant Ponzi scheme that destroyed, millions of lives, his family and others around him. It's really sad.
Yeah, it is. It's we've done shows on the Ponzi scheme, and now people would say it's no longer recognized as a Ponzi scheme. It's a Madoff scheme. If you want to go down that road with it, that's fine. Either way, it's a sham. And I know when we have discussions with our clients and people are sitting down with us and they want to ask, is our money safe? Basically, what they're trying to ask is this another Bernie Madoff? And I mean, we laugh at that because thank God it's not. And what have we done here at Money on Top and Brayshaw Financial Group is, we've got Pershing that we're working with, and Sage Point Financial is our broker dealer. These are all places where you can be assured we're not printing statements on a 1980s printer and sending them to you.
I know. What's really sad about this whole thing was that, we've created different, walls to kind of alleviate, as you're speaking to remove that question or doubt. Like, people don't make checks payable to Brayshaw Financial Group. we've made it that way intentionally. And, people made checks payable to whatever, Madoff Securities or whatever he was, whatever the name of his company was. But he scammed everybody. He scammed banks. He scammed big movie stars, you name it. Gosh.
Nobel laureate Elie Wiesel, one of the people of note, Kevin Bacon, a lot of people. We're talking about charities. As they dug deeper into the Madoff scheme, and it was spanning over 15 different countries. There was a lot of charities that had given money. There was a lot of other funds and hedge funds that had given money into for him to work with, and it was massive. Nothing that has ever been seen before. And Bernie was this legend. People forget that he wasn't just some guy that showed up on Wall Street and was started churning out a scheme. He was there for so long, and he created the NASDAQ. He was one of the innovators of electronic trading.
Oh, I know. He was was he the chairman of the board, I think, or something like that, or was on the board of that. He understood the rules, built the programs, built the rules around it and how to do it. So he knew best on how to innovate fraud in that arena. And I think that's really a scary thing. And sometimes the closer you get to, that stuff, the easier it is to create fraud. I think, I have clients that, have experienced fraud in the industry who have been part of Ponzi schemes, and those are kind of pick up where you got hurt and move forward kind of scenarios. And even to this day, they still are always kind of like that hurt, that burn. It sticks with you forever. And these people lost billions of dollars, but I think they've been able to recover basically $14.4 billion of the $19 billion in principle, which sounds good. Like, hey, listen, they only missed out on what, $4.6 billion of recovery.
75% has been recovered, right?
Yeah. But people thought they had about 65 total billion
right
in all their accounts.
It's a close to a chapter. And it's one that has completely changed so many of the ways that the SEC investigates or goes into and looks into financial doings. It's really sad how preventable it was, because really what came down to is there was a room under lock and key in his three floors that he was taken up in the Manhattan high rise there. This one room where it all happened, billions and billions and billions of dollars. And when asked about it, he said, he's poo-pooed the investigators, the SEC investigators that were coming through, kind of doing their typical rounds, and they just overlooked it.
Basically, Madoff pled guilty in 2009 to fraud, money laundering, perjury, and theft. His son quotes his dad sat him down and said to the family, "The money is gone," end quote. It's all been a big lie, and that was found in the Truth and Consequences book that he had written, the autobiography. This tragedy is horrible, and Seth, as an auditor, doing compliance work myself, having done all of that stuff, what I think is probably the most common scenario that people get kicked off. I always seem to hear the event beginning with a recessionary period, a drop in the market. They were afraid of losing clients, and that happened for them. And Madoff recounts back in the 1990s. And having seen this stuff, actually having worked on a lot of things that involved the discovery of that stuff in the past in different areas, it's usually people are just afraid of losing clients. They had a pullback or a loss in the market, and they're not fun conversations to have with people. Hey, the market pulled back on us last year. We were able to recover, and those things are good. We went through that process. But when you have big things, you're afraid of losing big things. And that is the temptation that some of these people are really that deal with. And it's hard. It's hard to deal with that stuff. But, I used to have a lawyer friend of mine used to say, if you have bad news, get it out fast. And I think that's the biggest thing is don't spread it out. Don't sugarcoat it. Just get it out. And he wasn't man enough to do that. And now, he died in prison basically without his family. I mean, one of his sons died of cancer, was at 48 years old. Another one took his own life. I mean, they claim the wife, cries herself to sleep still for the pain that he's caused people, and she had no idea this was going on. Sin's horrific, and it comes out, and it's bad when it comes out, and it affects a lot of people, and that's a sad day.
Yeah, hopefully we never see anything like this again, and we can, just take a look back and say, wow, what a lesson that has been learned, and hopefully the people that were affected have recovered and are okay. Right? Our thoughts, our prayers are with those that suffered through this crisis. You guys, that's going to do it for us at Money in the News. We're going to take a quick break. We're going to be back with the IRA mistakes that hopefully you never have to make, especially after listening to the show today. We'll be right back. You're listening to Money on Tap.
For a number of our listeners, they have a lot of questions, and you might be one of them. Today, we're just offering what we call Zoominars, webinars over Zoom meeting rooms, where we have top experts, Social Security, estate planning, and financial planning experts for you to speak with, do a private consultation that way today. We're also having webinar-based Zoominars where we're going to have multiple groups where you can be part of that and enjoy that as well coming up here in the new year. Give us a call at 855-226-8551 or email us at info@yourmoneyontap.com to schedule your Zoominar.
Now back to Money on Tap with Ben and Seth.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Folks, this is one of those shows that we're going to have a lot of fun with. And we hope that if you made it through Money in the News, you're here for the long run. IRA. What are we even talking about? You guys are already not making sense to us. Do I have one or do I not have one? Okay, so money kind of works like this, right? There's a couple of different buckets that you can have your money in. One we call qualified, and the other one we call non-qualified. And believe it or not, you're already familiar with one of those buckets real well. And that's your savings account. That's your checking account. That's your house. That's taxable. That's what we're talking about when we say non-qualified. So there's that bucket of money over there. This other bucket of money that we talk about all the time is qualified money. And qualified means 401k, 403b, IRA, Roth IRA. So these are the things that we're going to talk about. Primarily, we're going to spend our time talking about the IRA and the Roth IRA, okay? And if you're wondering, well, why would you even mention qualified as a 401k? Because it's all qualified money. It all qualifies, and that's under the tax code.
I think the thing is a lot of people use the conversation of pre-tax, but not all qualified money is pre-tax, and Roth IRA falls underneath that. Same with the Roth 401k. Those are after-tax dollars that grow tax-deferred and tax-free, and they come out 100% tax-free, and that includes the growth. So if you put $10,000, $20,000 in your Roth, whether it's a 401k or an IRA, you're going to pay taxes in the current year, okay? And then as that thing grows, let's say that thing is $100,000 someday or $200,000. Well, that entire sum is 100% tax-free when you take it out.
Yeah.
It's a phenomenal vehicle. It's a wonderful planning tool. And when accessed correctly and properly, used in certain, there's times when you want to be careful when you're doing Roth or Roth conversions. But we like to talk about those things because these are strong opportunities that when the time is right, it's a great opportunity. I'm going to talk about one client who did one thing that I thought was interesting today, and we'll get to that with Roth conversions. But with the IRAs, with the qualified, that's all those pre-tax dollars. That's all the money that you put in where you're either taking pre-tax dollars and sticking it in, or you're taking, to be complicated here, after-tax dollars and putting it in an IRA and then getting the tax money back when you file your taxes.
In the form of a deduction.
Exactly.
Right.
So it turns out to look and smell like pre-tax money. So let's just call it that.
Or if you're in the 401k world, if that's your qualified money bucket you're contributing to right now, the pre-tax would be a reduction of your income. It just never becomes taxable. It goes straight into the 401k. Your income gets reduced. And so the difference there is that the IRA, it becomes income, and then it goes into the tax code, and you deduct it off the backside.
To make this more complicated
Let's
for
go
all
for it.
our wonderful listeners out there who are like, all right, you lost me already.
Head spinning.
Okay, that's okay. But there's lots of different types of IRAs.
Oh, boy.
Oh, boy.
Oh.
There's SEP IRAs and simple IRAs, which are not simple. And
Which one's the best one?
Right, exactly. So we're not going to get into the detail of the different types of plans today.
Well, we are going to talk about that idea of, one's better than another, right? Because hey, they should be, right? One should be better than another.
Well, one would be more suitable for somebody versus another.
Very good.
But I think the thing is that, as we go through these 10 points of the things to consider when it comes to your IRA or your retirement plan and all the different things, we'll talk about, they're pretty much going to go almost directly across the board, right? And so we have a couple we're going to talk specifically about IRAs only and Roth IRAs only. So that's like the traditional IRA or the, rollover IRA or things like that, like all these different things we're talking about. So if you have questions, we understand, give us a call. Some of the calls we get are hilarious, which are great. I love the fact that people are just like engaging us. It's great. We have people call in giving us suggestions on articles and show topics. It's fantastic.
Yeah, or telling me not to say that. Or I didn't like that part. And even those are a lot of fun, too.
I have to disguise my voice sometimes, Seth, when I do that. So it's hard.
Yeah, it's fun to heir Ben from across the office. Hey, why don't we get going on this? We're going to have a bunch of fun, and we're going to run out of time. If we don't, we're going to make some sense through this. And if this is a first-time listen for you, we're glad you're here. Hold on to your seat. It's going to make sense. And you can come back and listen to it in a podcast. You can come back and grab these bits and pieces. The thing that you want to really focus on at this point is just listen. Try to be open. Try to listen. Try to apply, if you can, to yourself what some of this means, and come back and do it again. And come back and find the next episode, because we want you to have this empowerment around. Again, this is your financial journey. And the more that you can take ownership of this, the better the experience is going to be for you, the more positive the outcomes are going to be, the greater the outcomes are going to be. So no matter where you're starting, there's something, or if you're experienced or not, there's something for you here today. And with that, we want to jump into number 1, waiting to the last minute to make your IRA contribution.
That's a bad idea. Bad idea.
Hey, you could miss the deadline. That's happened.
Well, I can't tell you how many people send it to us that day, mail in their tax return, and we send it up, and and right now if you're counting on the mail to be on time, you are gravely mistaken on that. This is not a delay scenario anymore.
Now, one of my jobs I've had in this industry was prior life in this industry was taking these checks that would come in. And I would pick up the mail on a daily basis and basically cashiering these checks. And these were not small checks for some of these plans. But, some of them were just like their annual contribution. But we would have some of these checks coming through a month after. And it was the craziest thing to have to sit there and watch the mail for darn near 2 months after the deadline, which has been April 16th for quite a while. Not this year, right? April 15th, April 16th. It's moved around there a couple of times, but this year we're going to look at May 15th.
May 17th, actually, this year. I mean, it's normally, obviously, everyone knows it's normally April 15th, but
right.
The fact that they have these, the last few years, we've kind of had this rolling past the weekend scenario. So,
well, the rule I just wanted to say is this: as long as you have that check post dated, like get the stamp, the date of whatever the last day is to contribute, it qualifies as it comes in the door. So it was just a whole kind of a fiasco and a hassle to try to work out. And there was most of the time there's no reason for it other than people are busy and it's not what they're thinking about, and they realize, oh my gosh, I got to do this now. And you don't have to. You can make this contribution. Well, you can make it any time throughout the year.
Yeah. waiting the last minute, I think the thing that goes to my mind when I'm thinking about that is just simply the inability to make money on it.
Huh.
I mean, you're here, throwing the money in April, but where was the other 3 or 4 months? Were you making the money in the current year for the previous tax year? I mean, some people, that might be the case, but don't let the money sit in the bank. Get it invested.
Yeah, I was glad you just didn't use the example of me waiting until the day before Thanksgiving break to turn in my paper to History 401 Latin American Civilization course that I stayed up for 3 days finishing. Procrastination, folks. That's you don't have to. You're going to be able to get a far better return if you get the money in the market than wait. That time value of money is a huge piece.
Yeah, I think the thing is that getting your money in, getting it working for you, moving it forward is really, really the key. And that's, I think, the number one focus. When I think of number two, and talking about making Roth IRA contributions even when you make too much money is a conversation or question we have by a lot of people, right? Listen, I make too much money. I'd like to do a Roth. I don't qualify for it.
Oh, well, that's an open and shut door. I mean, sounds like it. Sounds
like it. Yeah, no, exactly. And I mean, I think the thing is that a lot of people don't realize there's what we call backdoor Roths. There's, rolling over other IRA funds, in doing a conversion. Those are all pieces that you can do. And I say backdoor Roth, and people say, what is that? Well, that's when you just literally make a contribution to your IRA. When you don't qualify for an IRA contribution, you're not going to qualify for a Roth contribution. So what the government does is they say, hey, listen, we're not going to let you take that deduction. They let you stick the money in the IRA, and it grows tax deferred, but you're going to have an amount of money that is not deductible. That creates a complication. Now, some people want to do it just to get – some people do that with an IRA, and I don't understand why when you really break down the math. And I can make a case for it almost in every instance. But they'll put the money into there, and they say, well, I'm getting the tax deferral on this piece, and I'm in this really high tax bracket. And, I look at someone who's paying, 37.6%, maybe some state tax too. So let's just say they're around 40%. Just let's round it up there, Yeah. I'm thinking about this and saying to myself, if you're making a non-deductible IRA contribution, why wouldn't you just convert that right to a Roth?
So you're telling me there's a chance.
A small chance.
I have a chance. Yeah. Okay. So at a glance, right, that might make sense what they're thinking. And it does. I mean, there is logic. There is reason. We get it. But there's so many different ways to work with money that you're in these IRAs or even outside of an IRA to accomplish that goal. It's just looking at it from a different way. What Ben said is, hey, go ahead, make that non-deductible contribution. Because if you make a contribution at your current tax rate and at your income and everything, it's going to be non-deductible. There's no way you're going to get a deduction on this money. But why not flip it into a Roth once you do it, which would then still grow tax-free, but then come out the other side tax-free.
And I'm going to say that this sounds very simple. And it is very easy. I mean, all of us do this all the time for clients. The thing is there is a very kind of like red flag, yellow flag. Maybe it's more of a yellow flag. I'd say it's a yellow flag conversation where I was reading an article about this, and I've seen it in a couple places where doing the non-deductible IRA contribution and then immediately doing a conversion with the intent to do a Roth contribution when you're not really supposed to has not been challenged back by the IRS yet. So I say that to buyer beware because that is something that is really concerning because you don't want to get caught off guard and find out that, hey, listen, the IRS determined that if you made a non-deductible IRA contribution and then converted it to a Roth in a single step, then the question would be, did you really ever intend to make a non-deductible IRA contribution?
So what would you do?
So this is what I would do. What I would do is I would focus more on Roth conversion conversation, right? I mean, the precedent is a lot of people have old 401ks, okay? And I would probably not steer someone towards ever doing a non-deductible IRA contribution because there's so many complexities. There's issues about, pro rata conversions if you have multiple IRAs and some with non-deductible, and you just can never get rid of all of it. It's just it becomes a pain in the rump, just to manage it, honestly. And so I would highly encourage everyone out there, don't do a non-deductible IRA contribution and leave it in your IRA because it is an absolute nightmare. But and until you've done it, do you realize what a nightmare it is? So CPAs will be thanking me for this on this podcast and radio show. What I would tell people to do is to focus on maybe taking an old IRA and doing conversion pieces each year. And sit down with a financial planner, give us a call, figure out how to do an IRA that might qualify in your income bracket. Maybe you're self-employed and you should be opening up a SEP or a simple IRA or a 401k for your business. Give us a call, set those pieces up, and then look at maybe converting some old IRA funds. That's the best way because honestly, no matter what you do, whether you're converting or making a non-deductible IRA contribution and trying to do a backdoor Roth, it's still going to be the same tax bite. So if you have that, I would look at that as an alternative. That's really a key, I think, for a lot of people to understand that just getting more money into your IRA is not always good. So here's my case. Here's my example of concern, right? So let's say you're in a 40% tax bracket and you put, you're 40 years old, you put 50 grand in there. It costs you $20,000 to do it. Okay, that 50 grand in 25 years is worth $250,000. Okay, well, if it costs you $20,000 of taxes to have $50,000 in Roth funds that are now worth $250,000, you really only paid $20,000 in taxes on a $250,000 asset. Now that's somebody that's in the 40% tax bracket, and I'm really surprised that a lot of people don't look at it this way because age and growth have a lot of factors in this. That's less than a 10% tax hit on the overall asset. Now, I'm pretty sure, considering all the – I know I'm going on a tangent, Seth, and you're letting me rock on this, but I'm pretty sure that our tax rates are going to be a lot higher in 20 years. I think they have to be. I don't think we can write $7 trillion worth of stimulus and not pay that back in some capacity, even if we're not in a full gusto pay it back. But we get a national health care system and we got debt and we got all these things coming. We're going to see some real expenses in our taxes. And that's a concern for me.
One other thing I might say on this is if it's a big enough concern, connect with a tax attorney. And there may be the possibility of getting a determination letter prior to making any of these things. And once you have one of those in place, there's no way that they can come to you and say, oh, we're going to, change the ruling on this piece. And that's something we don't really dive into. If you need some referrals for that domain, we can go ahead and try to get you connected.
Seth, I've talked to a number of CPAs about this, and I know you and I've chatted about this. There's a lot of mixed opinions, and the reason I only say this is because there is no determination by the IRS.
Yeah.
And I think it's all going to look at intent. I mean, if you were to do a massive IRA contribution and slap that thing into a Roth, the IRS is going to say, hey, look at me. Like, we told you can't do this. You make too much money.
Right.
Like, that's not something I really want to legally pay for. And I think that's what a lot of listeners want to. So I think if your non-deductible IRA contribution was done in good faith and converted, and one of the articles I said was converted over a period of time or converted at a later time instead of in its immediate
the window
form.
needs to be longer than a couple of days.
Even the same day. It's like people are doing that in instantaneous moments.
Right.
So that's where I would flag some caution because I don't want listeners to think that doing a backdoor Roth is as rock solid as it sounds by a lot of people, but I would say it's not impossible.
So, folks, we got caught up on that one a bit. Gifting out of your IRA directly. So that may not be something that's in your vocabulary even, is gifting out of your IRA or not gifting out of your IRA. And what are we talking about here? Basically, when you're gifting out of your IRA, and let's say you have a nonprofit that you're wanting to give to. Okay, so there's a couple of ways that you can do that. And one way is that you can go ahead and receive those funds yourself, and that's an indirect way. You'd basically get the income or be reporting income on your IRA as your traditional IRA income, ordinary income, and then you would be sending it off to your deductible contribution towards whoever you want to benefit there. Okay, they have to, of course, be qualified under the tax code that way as able to receive those and able to be a deduction for you. Well, you're going to pay tax on that. So one of the things that we talk about this a lot with the RMDs, the required minimum distributions to happen at age 72 with an IRA, is having a strategy built around that so that you're giving those contributions directly over to the check gets written straight from the wherever your IRA is at. It goes straight from there over to the organization. So you never even receive the funds. And what that does for you is it never becomes a part of your income, never becomes a part of your taxability. And so it's a far more efficient way for you to be gifting, especially, gosh, we love charitable-minded people, and how can we help you be more efficient in doing that?
Yeah, and it was with the Trump tax cuts that this actually became a much more popular way because of the increase in the, like married filing jointly went from an automatic $12,000 deduction to $24,000 that you just got for free. You didn't have to do anything.
And try to get enough deductions in written up within your giving to be
your charities, your health, like all that stuff. It was really, really hard to get over $24,000. So this is a huge issue of just it's so simple, it's so easy, right? And you're just saving yourself some simple tax dollars. I tell people we could set that up. Like if you tithe at a church, you could set that up automatically.
You can,
and it would just be done with it. You never have to think about it.
And if you get the gratification out of getting the checkbook out, we understand. There's no reason that you can't write the check. Just don't put it in the basket.
That's horrible. Okay, number 4, self-directed IRAs are a good idea. This is one of the areas where I think there's a misnomer. Like, hey, I can buy gold in a self-directed IRA. I can buy real estate. I can do all that stuff. This is a very dangerous area. This is taking on a level of risk that's just abnormal for most people. And honestly, I have questions for people who now. If you're dealing with inflation risk and you want to get real estate, and you want to get the money out of the market, like I could see that being a play, but you're taking on a whole nother level of risk in real estate and self-directed IRAs, which is the primary use for those things. But I mean, you're talking about liquidity risk. You're talking about the value risk of real estate. There's just so much beyond that. Just rental risk, all of those pieces, a whole different piece to do it. But I will tell you that I did have a client come to me who wanted to do a self-directed IRA for some real estate. And when they did the self-directed IRA, they bought a big piece of land. They were looking to subdivide it. Very interesting. And I said to them, and they said, listen, we think we have some buyers for most of this land right off the bat. Like, we think we're going to make some substantial money. And I said, well, you know what you guys should do? You're retired. And I said, why don't you do a Roth conversion before you buy the land and open up a self-directed Roth program? And that way, when you sell the land, the profits will go back into your Roth. And they were like, wow, that's a great idea. So, those are things you can do, is be clever about how you're working through some of these things. Now, the bad downside of that is if you did the Roth conversion, paid the taxes on the entire converted amount, which you have to pay out of your own pocket. So they have to come up with the money on their own. So that could be $20,000, $30,000, $40,000 on $100,000, right? So then if the real estate declined in value and you sold it, you would have actually lost money, because if it was still an IRA, you'd only pay taxes on the value of what you. So, right, you have to really see appreciation in value for the Roth to be conversion. Like I, for instance, back in March, April, and May, I was converting certain stock assets that I owned to a Roth because they were so undervalued. I was like, I'm not selling this company. This company is going to come back and it's going to be great, but I'm going to convert my shares to a Roth to take advantage of that. And those are types of areas where you can look at that piece. But self-directed IRAs are not always a good idea, and it's super, super dangerous, but something that we have conversation about regularly.
Not contributing to a retirement plan for your short-term issues. Okay, so whatever's going on in your life right now that's delaying you from starting to make these contributions to your IRA, stop it. Make that a commitment, just like you make whatever it is that's important to you, significant to you. I don't care if it's Starbucks or your coffee, or if it's your favorite whatever. I know we have these places that we make concessions. Okay, don't do that with this money. Make sure it's a part of, like, the first part of the year. You have a plan of getting that money out of your bank into the retirement program. Okay, that's going to help you long term. You're going to be so grateful down the road that you just didn't delay.
That's a really good point, Seth. I mean, so much of this world is have it now, and they're forgetting about later.
Yeah.
That's a problem, for sure.
What do you think about triggering a taxable event on an indirect rollover? I get that question a lot because it's just not understood how IRA money or qualified money goes from qualified to qualified. And the question is this taxable? Is there going to be some kind of a taxable event if I move money from the 401k into the IRA, or from one IRA that's here over to the IRA there? And that, if you're going direct, which means you're custodian to custodian, okay, there's companies out there that are going to send you a check, but on the check, it's going to have the new custodian's name on it for benefit of you and your IRA. And sometimes they'll put your new account number on there and that kind of stuff. So there's no way that you could even take that check and go cash it. The biggest risk you have there is the check just doesn't arrive and they issue a new one. That's not a taxable event. What could be a taxable event is if you take receipt of funds from your IRA and you say, just go ahead and write me the check for $100,000. Well, they're going to go ahead, if you're under 59.5, they're going to go ahead and usually take out about a 10% penalty on that. And then you're going to go ahead and say, well, I'm going to roll this over into my new IRA, but you're going to be responsible for that 10%, right?
Yeah, if you don't do it in that 60-day time period and you don't get it in there, you're done.
Yeah.
Yeah,
there's no 61 day.
No, there's no 61 days. And trust me, the 60th day is too late. Okay. But, the other scenario is that if you did do that, like let's say you had a rollover, you did an indirect, you had them send you the check, you move that money in, let's say it's $20,000, you say, hey, you know what? Hey, Ben, I got another IRA out there, and it's like $5,000 or $10,000. Let's say it's $10,000. You say, I want to do that too, and you take the check in the same tax year, and then you want to write the check into your IRA, even within the 60 days. That's a taxable event. You're only allowed to do one of those in a calendar year. A lot of people don't know that, and that's a big problem.
Folks, you're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And we are talking about, some of the tips and the tricks around IRAs. It's a huge part of most people's retirement and the retirement conversation. Hopefully you're getting a ton out of the conversation today. It may not all apply, and that's okay. But you're sticking around, you're learning, and you're listening, and we're going to be right back. You're listening to Money on Tap.
Folks, we have a lot of fun doing this show, Money on Tap, and Ben and I have been financial planners for years and years, and our goal here with you is to bring you into the room, have the conversations that we have. We think these are critical conversations for you, but we understand this is a limited space. And what we'd love to do is to open the doors to you with us at Brayshaw Financial Group so you could experience what it means to have three-dimensional planning in your life. Let's take a look at all sides of your situation, your scenario, and see how we can put together the best plan possible, taking into account your risk. How much can you have in the market? How much do we need to have set aside and doing different things for your life? That's what we do as planners, how we engage with you, and we welcome you to do that with us. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Now, if you have $250,000 that are investable assets today, our planning is free to you. We want you to have the playbook to have a successful experience in retirement. Give us a call, 855-226-8551 or info@yourmoneyontap.com. Ben and I welcome you to Brayshaw Financial for complete wealth management.
Now back to Money on Tap with Ben and Seth.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Folks, if you're listening to us via podcast, we appreciate you being there with us today and going back through some of these episodes that we've created for you and having some fun with us on them. And the likes and the listens, they all help us, and we appreciate that. If you're listening to us on the radio today, thanks for sticking around. This is an hour of your time that you can spend doing whatever you want. And the fact that you're here with Ben and I today, that means a lot to me. And I appreciate it.
It does.
Yeah. So we're going to get rolling on the rest of these things here. Before we run out of time, we are on number 7, not properly noting your beneficiaries. And this really is one that we see day in, day out. It happens so often that people just don't really understand how the estate works or how beneficiaries work or what the benefit of an IRA having a beneficiary in there is. And I know some people very well that still will not make this change, and that's fine if this is how they want to do it. But a lot of the times people will just say, my beneficiary is the estate. Well, what that will do is that will put that money that could have passed probate back in to probate for basically whoever you have as the executor, is what we'll call them in Oregon is the executor of the estate, the person that's overseeing the estate and those decisions, to allocate those money. However, those things have been decided in their will, or it's a judge that will say, okay, this is what the will says. This is how you want it broken up in your will and given to your beneficiaries. That way, either way, that gives an opportunity for creditors to come after that money and possibly limit the contribution or the gift of that a beneficiary could receive after you pass away. And that's what a beneficiary is here. It's listing who you want to receive the money that is left over in your IRA after you pass away. And a lot of the times that looks like the primary beneficiary. And most of the time that is the spouse, 100%. And then after that, there's the contingent beneficiaries that are, if something has happened to the spouse, who does that money go to next? And then there's even this other level of per stirpes, which so many people just go, I don't even know what per stirpes is, or just they don't think it's important. But that's that other level of planning where you just want to have or ask the question, what does this even mean? Why is this even important? And it is critical. It can save so much money for your beneficiaries and so much time and hassle to try to figure that they don't have to figure out, and you don't even have to worry about it, because after you're gone, or as somebody passes on, it's such a sad thing to see families not be able to come together or to have friction in places where they don't have to. It's an unnecessary battle, folks. And so that's why we would say, make sure that your beneficiaries are who they are. You know who they are. You know how you want those allocated. Understand what per stirpes mean. We're not going to get into that. But these are the things you want to be having the conversations around and making sure that you've just checked the box.
Seth, that's great advice. And something I would definitely say is so underwhelmingly educated in so many ways. Number 8, don't double up on tax shelters. This is a simple one. This is
you say it is, but it's one that's so misunderstood.
Oh, I know it is. It's like municipal bonds that are tax-free most likely have zero belongings inside a tax-deferred event. I mean, if it's already tax-deferred, your IRA or your Roth IRA or whatever, buying a municipal bond, for instance, that's tax-free isn't going to do you any good, and you're usually getting a lower rate than a regular corporate bond in the same risk level, and it's the same difference except for you're getting a lower rate.
Yeah.
Now, I could envision in a warped period of time where maybe government bonds, municipal bonds are more relevant because of a pandemic or something, something crazy where only the government's the only financially backed scenario, and that's what you want to have. I guess I could fathom that, but it's never happened. So
there's always the yet. Yeah, I would say anytime somebody.
I never want to say never.
If somebody's talking to you about a tax benefit or a tax shelter, and that happens to be money that you have in your IRA that they're talking about using that direction, that's when you want to ask the question. You want to make sure that you get clarification on that.
Number 9. Don't forget about your spouse. No, that's not what I meant to say. What I meant to say is don't forget about your spousal IRA.
Oh, good.
For all of us, men or women who have a husband or wife at home, who are not working at a job that pays them income, you are eligible to do a spousal IRA with the income limits associated with that. And that would include IRA or Roth. So just because you may not have an income-paying job, but you might have the hardest, most thankless job of being a mother or a father at home, you still get to do a retirement plan.
You qualify.
You qualify if
For
you have
qualified.
the income limit. Yeah, you qualify for the qualified plan.
Yeah.
That's for sure. So
Yeah.
that's something that seems to be overlooked quite a bit. I have a family member who was like, "Oh, you mean I can?" And I'm like, "You didn't know that?" So that's what brought this to light. And you just presume that whoever they're filing their taxes with them are saying, "Hey, listen, you should be making another IRA contribution or a Roth
Yeah.
for your wife."
Yeah, and oftentimes we will just see one person that's kind of in charge of the finances. That's where they spend time, and I don't think it's an intentional piece. Most of the time, it's just they just didn't know that they could be doing this. But occasionally you might see people that have really only taken care of themselves. Now, an unfortunate way that could work. We won't even get into that. That's just there could be some side effects there, some ways that works out that would not be very good. Healthy finances, healthy interaction around that, and understanding is what we want to have. Last but not least, I don't like IRAs. I like Roths, is what I like to call this. What should I do? Should I do a Roth or should I do an IRA? And there's this great debate out there, and it's one that's fun to get into for sure. But the question really comes back to, what's the right thing for you to be doing? Is it better for you to be doing an IRA, or is it better for contributing to an IRA, or is it better for you to be contributing to a Roth? And we've done the math on this of, if your tax code is the same today as when you retire, is there a benefit to doing one versus another? And the straight answer on that is, folks, no. The net will be net zero as far as any benefit, as long as the tax code today, or your tax code today, what you're paying on your ordinary income it would be the same.
Yeah, and I think that's the thing, right? Nobody's sitting around saying, "Hey, we're at some of the lowest tax codes in history, and I expect that to stay about the same after a $7 trillion stimulus package." So, I really I go back to the example that we talked about earlier, and this is what, no pain, no gain, right? So pay the taxes. I think Roth has a great opportunity for people. I feel like I'm going to get to my retirement years and say, why didn't I do more Roth?
Yeah.
Why didn't I convert more of these stocks? Like, they're high now, but you know what? Where they're going to be in 20, 30 years, they're going to be a lot higher probably. Yeah. Why didn't I convert those too? I think there's going to be a lot of Roth regret. I really do.
Be a real thing.
I think it's going to be. I think people are going to get counseling over it. I think there's going to be some real concern.
Well, we talk about the tax trap with qualified money. Everybody's just been stacking money in their 401k and not putting anything in the non-qualified side or in the Roth side, and they're stuck.
The younger you are, the pretty much no-brainer decision it is to do as much Roth as you possibly can.
Yeah.
No matter what your taxes are, unless you just can't afford to pay the taxes. Like, if you can't pay for food, groceries, utilities in the apartment or the house, then that might limit your Roth scenario. But, at that point in time, I really don't think that you're going to be making that much of an IRA contribution that's going to be offset it that much that's going to make a difference. So if you're really that strapped, you're probably not even making an IRA contribution. But if you add 40 or 50 years to a future distribution on a contribution you're making now, and what you're going to pay on taxes on, $6,000,
yeah,
even if you're in a 50% tax bracket, and you're going to come up with $3,000. If that $6,000 in 50 years is worth $200,000, you're not going to be crying about the $3,000 you paid in taxes.
So can I say the argument on the other side of this?
Please.
Okay. A bird in the hand is worth two in the bush, my friend. And if you know what the code is now, and if you're going to get a discount on that money today, and I can't tell you that you will tomorrow, might as well take it. And that could be one way that you think about things. And in terms of what
you're right.
No. In what we do, I would say go with this idea. Okay, we talk about it in so many different places, but there is a model of diversification in what you have in the market. Okay, we're not going to be 100% in this one thing here, right? Because that's not diversified. We want to have.
You didn't put all your money In one stock?
In gold.
In gold?
Robert Kiyosaki. No, I did not. I have yet to do that or tell anybody that they should do that. Put it in the mattress, bury it in the
You don't want
yard.
to just tell that to somebody as a joke and let them leave the office? No. I'm just kidding. Go,
let me think. Let me think on that for a minute. We'll get to that next episode. Yeah, so there's this idea around diversification. I think people seem to understand that when we're talking about inside of your portfolio. Let's try to be diversified. But there's other areas of your life, and I think maybe one of these is time, work-life balance. We hear that a lot. That is a model of diversification. But in tax code, we started this show talking about non-qualified and qualified, and Roth being one of those places that is considered qualified, where the distribution, the gains and also the distribution on those monies are tax-free. Inside your qualified IRA or your qualified traditional 401k, the benefit is on the front end where you don't pay taxes putting the money in. It grows tax-free. That's great. But the distribution is taxed as ordinary income. And on non-qualified money, that's taxable. It's taxed along the way. Now, you buy a stock today, as long as there's no dividend on that stock, it's just you buy the stock. All right, you create basis at, let's say you buy it at $100, and let's say 20 years down the road, you sell it at $200. That $200 is now taxable on the sale of it at a long-term capital gain tax rate, whatever that is down the road. Okay, so we've talked about 3 different versions of taxes there. And that is diversification in the code of your money, the tax code of your money. So get diversified. You can do both. You can make a Roth IRA contribution this year as well as your traditional IRA contribution. So don't think it's one or the other. Don't get locked into that thinking. Stay flexible with us here, folks. That's going to do it for us today on Money on Tap. We hope you've enjoyed the journey. There's so much to talk about in the world of financial planning and the world of personal finance, and we just still can't cover it all, at least not today. But we appreciate you sticking around. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. My name is Seth Krussman, and once again, Ben Brayshaw. We're here for you as financial planners at Brayshaw Financial.
You can also find us at Facebook. We're at /3D Investing. We're also on Twitter at BFG_LLC. And as always, you can also find us at yourmoneyontap.com. Thanks for listening. Thanks for liking our podcast. We appreciate you, and we can't wait to make it a great day and a great life with you here at Money on Tap.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.